What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. Welcome to Raise the Bar, elevated conversations around entrepreneurship, capital raising, and real estate. I'm your host, Seth Bradley. Today, we're raising the bar with Zach Haptonstall, the CEO of Rise48 Equity. He's led more than $2 billion in multifamily transactions and built vertically integrated systems and platforms most operators can only dream about. He's a true builder, a gifted operator, and a master of scale. Zach, great to have you on.
Hey, thanks so much, Seth. Really appreciate it, man. Thanks for having me on. Looking forward to bringing some value to your listeners here.
Of course, brother. Really appreciate you. Man, to kick things off, as entrepreneurs, this question is harder than it is for most people. But when a stranger asks you on the street what you do you tell them?
Yeah, I know. It's a good question. Even recently, I'm at networking events, and I try to change it up to keep it simpler. And I just tell them we invest in apartment buildings, or we raise money and we buy apartment buildings, or we flip apartment buildings. So try to keep it somewhat simple, high level.
For sure, man. And you guys are really focused too. I mean, even in a tough market, as most people would think right now, you guys are really focused. You're vertically integrated. You guys are focused on multifamily and really crushing it right now. What's really enabled you guys to really get momentum through kind of this, what most people call a real estate downturn, and you guys are really elevating and going fast?
Yeah, no, it's a good question. So, I mean, it's been a grind, no doubt. And I think, we are our volume, the amount of capital we can raise, the amount of deals that we're buying, we are significantly down. This is our slowest calendar year for acquisitions in 5 years, believe it or not. And so, I think maybe we still are kind of outpacing a lot of people, which is good. We're fortunate to find deals, but it has been tougher for us. But we really try to stay just consistent, and it's a grind. It's doing webinars, taking the investor calls, staying in touch with the brokers, sourcing deals. Obviously our biggest focus has been on operations. My biggest focus has been on operations, really building out infrastructure. And now I've been able to really, delegate. We've built out a capital formation team that's raising all the money. I just hired a new acquisitions guy a few weeks ago, and I've been introducing him to all the brokers. And so it's just kind of keep the main thing, so to speak. I think the last few years in the industry, so many groups have just gotten beaten down with the adversity and get discouraged, and they stop, doing the fundamentals, which is easy to do. It's so hard to raise money right now, but we just kind of try to eke out these deals and keep grinding and stay consistent on that.
Yeah, what I'm hearing there are you're just staying consistent, right? You've built systems, you've built infrastructure through your operations, whether that's acquisitions or asset management or raising capital. You have systems and processes in place, and you're just staying really consistent with that, where I think a lot of people are just kind of, they let that thing, when everything's not going smoothly, they just kind of let those things go. You've been able to stick to the plan.
Yeah, that's exactly right, Seth. There's a lot of adversity, and I think it's easy to give up or to get discouraged. And that's what a lot of groups have done. Frankly, a lot of groups are toast now, unfortunately, just because of the adversity they've faced. But I think we've been able to weather the storm. And whether we've got critics and haters in the media or our competitors, whatever, we kind of battle through the adversity. And, we bought a bunch of deals right before rates skyrocketed, and we've been able to recapitalize those, get new loans, preserve investor capital, never missed a monthly debt payment. And so we've been playing defense for that window of deals like a lot of people, but we've also realized that this is a good opportunity to play offense. We've all heard the cliche quote, Seth, from Warren Buffett, I think it was. It's when everybody's fearful is the time to buy, right? And so, we are taking somewhat of a contrarian approach. And I don't even think it's contrarian. I think a lot of people realize now is a good time to buy. They just can't necessarily raise the money or the equity. But we're buying a lot of distressed deals at what we think is the bottom of the market right now. And so if we think we're buying deals in, 24, 25 especially, we think, by the time you get to 27 through 2030, you should have a lot of tailwinds where supply across these growth markets in the Sun Belt, which is where we're located, should have gotten absorbed, which will cause concessions to burn off. It'll increase organic rent growth, where we've been really facing negative organic rent growth for 3 straight years, Seth, across the Sun Belt. And so we should have those tailwinds. Interest rates are cutting, which should cause values to go up. So we just feel like now is the time to be attacking, really throughout 2020. We have that window still. So that's kind of been our philosophy, even if it's challenging to do so.
Totally. And I agree. I agree. I think right now is a fantastic time to buy. It's a really hard time to buy, right? I mean, sellers aren't necessarily trying to sell, they're trying to hold on if they can. So transactions are low. So it's hard to find good deals because of that. Interest rates are still pretty high. It's hard to make these things cash flow, but and it's hard to raise capital, right? It's hard to raise that equity. But if you're able to do it, it's a great time to buy. And you're going to be looking back at this time 5 years from now and saying, man, we should have bought five
I
years
know.
ago.
Yep.
How are you able to? The thing that I'm seeing in a lot of deals are it's really hard to make them cash flow out of the gate. Are you kind of projecting that there's not much cash flow out of the gate, or are you guys still able to find good enough deals where there is a little something coming along the way while we wait for kind of the market to turn here?
Yeah, good question, Seth. So yeah, I mean, the deals that we're buying, there is cash flow in year one, but it is extremely tough to find them. It's truly a needle in a haystack. Like we did a webinar yesterday, and we have a graphic since the end of 22. So it's been about 3 years. We've now underwritten over 1,000 different deals, and that's like actual from our Excel spreadsheet, like 1,000 deals across Phoenix, Dallas, North Carolina, and it's like a 2% hit rate of deals that work, right? And so, like, literally, we have 6 analysts, and we have brokers sending us deals literally every day. No exaggeration. So we're underwriting deals every single day, and most of them don't work from the beginning. And then if they do meet the crime check, the median check, we're like, wow, this thing's actually close to, penciling. Then we have our local asset management team go shop all the comps. And then that 99% of the time that kills the deal once we get to comps. And so the biggest challenge that we've found for deals to make sense is that, we are a value add business plan type of group, which means we need to buy a property and there needs to be some type of business plan where we can increase the rents and increase the NOI. And what you've seen across the Sun Belt, which is, Arizona, Vegas, Texas, Florida, Atlanta, the Carolinas, is that because there's been so much new supply, concessions have been significant. You've had negative organic rent growth. So rents are going backwards in a lot of these markets. And so we have not sold a deal ourselves, Seth, since July of 22. So about 3.5 years now, because it hasn't made sense to sell. We probably won't sell anything in 2026 because of where values are at. And to your earlier point, the only people that are selling deals, we've seen two common themes. One is they are distressed and they have to sell because of a loan maturity. And so getting back to your cash flow question, we have actually had a lot of deals that are operationally distressed, meaning that they're just kind of tanking operationally and they need to get out of the deal because it's all falling apart. Those deals don't pencil for us because there's no cash flow. You know what I mean? Like, we've actually had lenders who have foreclosed on other groups' deals come to us, say, hey, you guys want to buy this from us? We're like, wow, this is a great basis. This looks like a good deal. Then we underwrite it and we're like, this thing is just falling apart operationally. We can't do it. There's no cash flow. So the deals that are working they actually are operationally stabilized, 90% plus occupancy, not doing, doing pretty well, but they have some type of loan maturity approaching where they cannot refinance to, get out of that loan. They are out of capital, so they can't extend it or buy a new cap, whatever it is. So they have to sell to pay off the loan to avoid foreclosure. So we've bought several deals the last few years for like basically the loan amount, and we're wiping out sellers' equity. And then the second scenario, Seth, that we've been buying deals is that it's less common, but we bought a handful of these deals where they've just owned it for so long, maybe 10 years plus. We just bought a deal a few months ago in Phoenix. They owned it for 26 years, like a true mom and pop. So they have like little to no basis and they haven't been pushing their rents for a long time. So they can sell at today's values and still make a profit. And there is a way for us to push the rent. So that's been the single biggest challenge, is finding a deal where your rents are so well below market that we can, increase the rents, increase the NOI to make it make sense in the model.
Yeah, that makes sense. That makes sense. If you guys had to alter your buy box at all now that the market has tightened quite a bit, or how has that changed over the last, let's say, 5 years or so?
Yeah, good question, Seth. So, initially we started in 2018 and we were buying like 60s and 70s vintage properties, and we have not bought anything like that in nearly 4 years now. So we've only done 80s or newer vintage properties. And you got to remember, like in 2019 through 2021, even first half of 22, You were buying deals really focused on basis because, especially in Phoenix, the growth was just so strong. And so if you're buying a good basis deal, maybe it was a little less inferior location, but we were hitting home runs and doing really well. Well, then when the market completely shifts and you're seeing, okay, now you got to really focus on the higher income demographics because the lower income, higher crime demographics, they're softening. You know what I mean? There's higher delinquency, higher vacancy. And then you don't want to be in those older vintage deals where you may have, mechanical issues like a chiller system. I mean, we've fixed a number of chillers over the years. We've done everything you can imagine we've had to fix with these different properties. So we haven't bought a 60s or 70s vintage deal in almost 4 years, just 80s or newer. We've been buying a lot of deals that are like late 90s, early 2000s. So just a little bit newer products. And we just bought a 2010 deal last week in North Carolina. And so, if we can find those deals that are a little newer vintage, better mechanical structure, but it has some type of upside or value add push, that's ideally what we'd like to see. But we still like 80s vintage. We just want to be very well located and make sure we have good bones. And so that's kind of how we have shifted. I would say it's demographics, it's vintage of asset. And then, I mean, even in the last 12, 18 months, Seth, what we've had to do to kind of last point of your question is that because the rental premiums are much less than they have been the last few years, for a deal to work, we've actually reduced the level of our interior renovation scope so that we're spending less so that our yield on cost makes sense to get a lower rental premium. And the biggest thing I mean by that is before we were doing full renos, meaning quartz countertops, new flooring, stainless steel, new cabinet boxes. Now we're basically doing like a new nice Formica countertop instead of a quartz. It's much cheaper. No subway tile backsplash because that saves a lot of money. And then we're doing cabinet doors, not cabinet boxes, because it still looks nice, but it's a lot cheaper. So we're still doing new flooring, stainless steel appliances, two-tone paint. But by stripping out those three things, backsplash, cabinet boxes, and quartz countertops, we're able to save about $6,000 to $7,000 a unit on our labor and materials. So before we were like 16.5, now we're getting down to like 9.5 to 10,000 per unit all in. So now we can spend less and get less of a rental premium for the economics to still make sense.
Yeah. Yeah. I love that, man. I mean, you're really, when you do it at scale and you do it at the rep level that you guys do it, you can kind of really change those tiny things or what seem like small things, and they make a huge impact across, a large property or many properties like
100%.
that. Yeah. Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more. Let's jump into raising capital, man. I mean, that's what this show is really about. It's really difficult right now to raise capital, right? Especially on the equity side. Investors are smarter. They are more skeptical, especially those that are experienced even in the multifamily space. Passive investors might have gotten burned or capital calls or, gotten to a deal where, they lost all their equity. I mean, there's some stuff going on out there right now. How have you been able to successfully raise capital consistently for all of these deals?
Yeah, it's a good question. So basically, I mean, we didn't do any capital calls in 22, 23, or 24. Everybody said, survive till 25, which we did, and then it didn't matter. 25, nothing changed. And so basically, we sold the first 11 deals we bought from beginning of 2019 through the first half of 21. So it was like over 200 million, 1,100 units. Those were all home runs. And then the deals that we bought near the end of 21 and beginning of 22, those deals were impacted by interest rates skyrocketing so quickly. And so then we adjusted our underwriting in the summer of 22. After that second interest rate hike in May of 22, we're like, oh crap, the writing's on the wall. We need to adjust this quickly. So every deal that we've bought since September of 22 until now, which is like 28 to 29 deals, $1 billion of real estate the last 3.5 years, those are all cash flow positive distributed to investors every month since acquisition. So those investors only know, positive distributions and good deals the last 3.5 years. The deals that were impacted were, again, end of 21, early 22. And we basically held out just through strong operations for over 3 years. In the beginning of 25, we started doing our first capital calls on that subset of deals that were end of 21, early 22. And we actually had really strong demand because I spent all of Q1 going to our lenders and negotiating new loans. And so for these deals, we were getting between 3 to 5 years of new loans. Like a couple deals, we got new 5-year loans. A couple others, we got new 4-year loans. Several deals, we got new 3-year loans. And then we basically went to investors and said, hey, the entire industry has been impacted by deals that were purchased in this period of time. And our investors know that because a lot of them have gotten burned by other operators. Like we have a lot of, investors with other groups and they've already gotten foreclosed on.
Yep.
Had to sell for a loss. I mean, we've been buying a lot of deals where sellers are getting wiped out, so they know it's happening. And we had a lot of positive feedback from investors saying, hey, I started getting hit with capital calls by other groups like 2 years ago, and they didn't get these long of new loans, like as much runway. You guys have done everything you can. We can see the difference in how you've been fighting, and the fact that your lenders are working with you says a lot. So we had overwhelming support, and we were able to recapitalize all those deals and extend them out and into a point where we feel confident, we'll preserve all that money. Meanwhile, we have this different subset of investors where the last 3.5 years, all those deals have been doing really well. And so, we've had that base continue to invest in new deals. And then we even have had a lot of those old investors who are kind of paused for a couple of years, realizing that now is the time to really be investing in multifamily in the market cycle, because they just realize what's happened and what we have going forward. And so I think the biggest thing has just been it sounds cliche, Seth, but it's so true. This is why people say it. This is why it's cliche. It's honest and transparent communication. It's just being real with the investors. I did over 40 live webinars the first half of 2025. It was very stressful. It sucked, but you grind through it and you jump on and you just are real with them and you tell them what's going on and what your plan is and that you're going to fight to the death to do what you got to do, and people respect it and they respond well. I think, just from getting feedback from our investors, they've said that other groups, I'm not saying that like we're the best and that every group is bad. I'm just saying that the contrast based on feedback is that the groups that haven't been like proactively communicating or not giving a ton of information, that's when they start to lose trust or they become skeptical or hesitant. And so I think just over communicating, we were blasting these people with emails. Like it was probably annoying a lot of them, honestly, but they can't ever say we weren't communicating. And so it's just constant communication, continue to grind it out and just show investors, be forward facing on what you're doing. I think that's been the biggest difference. And then, there's not as much deal flow, but there's not as much competition either, right? And so in the past, I think investors are having to choose between different operators, different markets for where they want to invest. And because we're able to raise capital and we're able to get financing from our lenders on new deals, there's not as much competition for the equity, even though there is less overall equity available. So I think that's been a factor too.
Yeah, totally agree there. That transparent conversation is really important. It does, it's like you said, it sounds a little cliche, but people don't do it. Like people
because it's hard. It's hard. It's not like it's easy. It's easier, Seth, to not do it. It's easier to just send a vague email instead of getting on a live webinar because it sucks. It's stressful. It's like you feel the anxiety flowing through your veins, but you got to do it and push through if you want to show investors that you're committed, right? And I think most people don't do it, but you're right, and that they don't do it, and that's the biggest difference.
Yeah, and these are intelligent people, right? Like they have at least $50,000 to invest, so like they're intelligent people. They've done well in life. Like you can have a conversation with them, and they're gonna get it. They see what you see. They see what's going on in the market. They see why some deals might be in trouble. But you need to be open and transparent about it. If you try to hide it and then they find out on their own, or then just a capital call comes out of the blue, or something crazy happens and they don't even know about it until it's already too late for them to make any decisions about it, then that's when they get pissed off. And that's when people actually get sued. And then operators are surprised by it. It's like, well, sure, the deals go bad and that's part of life. But you also need to keep your investors informed and be open and transparent about what's going on so they don't get angry.
You said it best, Seth, and you're an SEC attorney, so you know better than I do. And it's kind of funny, like we always check in with our SEC attorney, but what I've learned is it's literally all common sense and instinct. It's like whatever you think you should do or how you want to be treated as an investor, that's what you have to do, is just constantly disclose and be proactive. Because to your point, these are accredited investors who have made a lot of money. They're successful, whether they're a business owner or they're like a high level executive in their job, they've faced adversity and challenges in business. So they do get it. And if you are just honest with them and explain what's happened, they're like, okay, it kind of disarms them and they get it. You know what I mean? They're not going to like come after you and attack you. But I think, as operators and as people who are raising capital, we are naturally people pleasers. Like, we want to do right by the investors. We want to please people. And it's really hard to share negative news. And I think, the thing that made it, just me psychologically, because this was me, I had to do all this. Like, I don't have like a rich uncle or a backstop or anything. Like, I had to kind of do this all on my own, sharing this news. I had to realize, okay, this is happening to the entire market. And so you have to put it in context. And we've done everything we possibly can. And we're going to continue to fight. And relative to everything else, we're actually doing really well. And we kind of explain that story and show it, and the investors recognize that. So yeah, I think if you get out in front of it, it's good. If they find out later, to your point, Seth, you made a great point there, that's when people get pissed off. It's just kind of human nature.
Totally.
Yeah.
And something else, staying on raising capital, you're a visionary and a pioneer in my mind as far as the fund-to-fund space is concerned. How did you identify that model early on as viable, as another channel for you guys to tap into, to raise that equity for? Because I'm Chief Legal Officer for TriVest. My listeners know that. And, a lot of lead sponsors don't know anything about it, or, they don't take it seriously. But you guys were out in front of it long before other people had even heard about it, and had tons of success and are having tons of success with your internal program. What was it about that? What was it about that structure or that idea that really told you internally, like, we need to feed this thing?
Yeah, no, thanks. And I appreciate you saying that. That means a lot. Yeah, so I can tell you, so we started buying our first deals beginning of 2019. And I mean, even then, it was obviously quote unquote easier to raise capital, but not when you're brand new. It was a grind to raise money, right? So I was trying to find one or two co-GPs who were key guys who had experience, who had the investor base, and I was going to be the sweat, and I was going to find the deal and run everything, and that's how I was going to bring value to a partnership. And so, we did our first deal or two with just 2 or 3 of us doing that, where we all have an active role. And then all of a sudden, I'm kind of seeing in this mainstream, and I'm starting to think, okay, I need to get other people to leverage their networks to raise money. But then at that same time, the SEC started cracking down on a bunch of big syndicators. Unfortunately, we didn't get caught up in this. We were honestly just too new, but I know a bunch of people that were getting subpoenaed. They were under investigation. And the SEC was basically looking to see you skirting or circumventing registered broker-dealer laws with FINRA, because people were paying a commission-based raise to co-GPs who didn't necessarily have an active role in the deal. And so I was talking to our SEC attorney at that time, hey, what do you think's going on here? What's going to happen? And he actually recommended at the time, this was in 2020, so it was kind of in the midst of COVID, he's hey, you should look more into the fund to funds model. So we by no means invented fund to funds. It's been around for a long time, but I kind of started researching more of that, and I was okay, this is a way for us to leverage other people's networks compliantly within SEC regulations, where I'm not paying them. And I'll give the disclaimer, I'm not an SEC attorney. I mean, so you are, Seth, but I'm not. So I'm just regurgitating what our attorney tells us. But basically if I can, leverage other people's networks because they are doing their own Regulation D offerings and people are investing with them, they're deploying the capital into our deal. That seems, I remember telling my partner Bikra on this in 2020, I said, fund of funds is the future of our company. This is how we'll be able to scale, because we need to figure out a way to leverage other people's networks compliantly. And then we started just talking to these people. And what happened, Seth, is at the end of 2020 is when we started selling our first deal, started going full cycle on a few deals. And so we had our LPs who are our direct investors hey, I like what you guys are doing, and I think I can leverage my network to raise money for your deals. And so they're can you pay me a referral fee? I said, no, absolutely not. We cannot, because of compliance, but here's this structure. And what I realized is that we needed to try to create some type of turnkey structure for these people to raise capital, where they don't have to worry about the back office admin, doing distributions, reporting, K1s. And so we had done a bunch of different demos with different investor portals, Seth, and we didn't really like any of them, frankly, for what we needed. What we kind of envisioned was, the user interface and the workflow of what an investor needs to go through. So in 2021, we decided, let's just build out our own investor portal and it's only going to be for internal use so that we can customize the way we want it. So we actually engaged these Ukrainian software engineers, and we started just investing money into building out this portal called Fundamental Portal. And so we started developing that, and the whole idea was that, okay, a fund manager who wants to raise capital, they're going to independently engage an SEC attorney, create their fund. We created a spreadsheet, which takes the main model, it flows into this, what we call a fund analytic. They can customize their economics so that, they're deciding how their economics work. Their attorney is communicating and disclosing those economics inside of their PPM and their docs. And then our marketing team on the back end, which we're grateful to have a really good marketing team. We've got like 4 or 5 really talented people here. Basically, they're going to create their whole marketing template for them, which is basically they're going to give them a custom slide deck, an email template, edit their webinar, but it's all going to have their custom economics. So now this fund manager has basically custom marketing to just, all they have to do is send it out to their network. It's going to be under their brand, their logo, and then their investors can really just hit commit, log into the portal, which is our portal on the back end, but it's a white labeled version for their brand, and knock out the docs, and then we'll do all their back office fund admin post closing. So it made it just easier for these people to compliantly raise capital. So if you make it like any consumer, right? If any consumer product, if you make it easier for the consumer, which in our case was the fund managers, then they're going to be able to kind of scale and raise. And so we just really started to focus on that instead of us having to chase. Because the first 3 years, Seth, I was literally pounding like 8 to 10 scheduled phone calls with investors. Because like in the beginning years, it was like, okay, my wife Grace would just like, because I actually hate social media. I don't like it. I think it's unhealthy, but it's necessary evil. And so like she would just pound like LinkedIn, Instagram with like content, and we're trying to drive people to a Calendly to set up a call with me. And so then I can establish a substantive pre-existing relationship. And I'm just pounding out these scheduled calls. It was exhausting. It was like 30 to 60 minutes every call. I did this for years, and I was like a robot to get 50, 100K checks. And then finally, we're like, you know what? We need to just focus more on fund managers so we can get bigger checks. And so we still raise probably 30 to 40% of the equity per deal direct to our LPs, but probably 60 to 70% of it is through capital partners, which could be like fund managers, registered investment advisors, registered broker dealers who we can compliantly, pay a placement fee to if they raise capital. And so we've just kind of realized how do we maintain 100% control so we're not giving up control rights or special member rights, but be able to leverage bigger checks. And that's kind of what we found was that middle ground to be successful.
Yeah, that's amazing that your attorney recommended that long ago in 2020. And like you said, like the Fund of Fund has been around for forever. It's nothing new, but it's kind of new for kind of this application because people they didn't want to deal with it because it's complicated. It's an additional fund. It's an additional security. You've got to find a CPA that knows the structure. You've got to find a securities attorney. They've got to get their own investor portal. They've got to do all the things that you do as a lead sponsor for themselves. So people try to avoid that because back in the day, you weren't really getting in trouble for this co-GP model getting abused. So people were just doing that because the lead sponsor does everything for you. It doesn't cost you anything. You use their portal, you use their CPA, you use their attorney. But then when people, as you mentioned, started getting cracked down on by the SEC, everybody said, well, what's the alternative? What else is there? And fund to fund is the answer. I mean, that's the answer, and that's where you're seeing a lot of the market pivot to now. But like I said, you did this years before anyone else was really focusing on it. So that's amazing. And like you said, you also mentioned the level of separation for the lead sponsors. So for the listeners out there that are lead sponsors, that are operating, you create this level of separation with the fund to fund. It's no longer you bringing somebody else into your deal as an active partner, and then their investors are your investors, and they can get you in trouble for doing something wrong. There's a level of separation. They have their own fund, they have their own investors, they have their own company, and they're just a big passive investor in your deal.
Yeah, and like you said, Seth, I think before everybody's doing co-GP because it was easy. Once it started getting enforced, there's so many barriers to entry, right? Where these people that want to raise capital, like, man, I don't know an attorney or the CPA or how to do distributions or reporting. It's so complex. So if you can remove those barriers for them and get to a level of scale, like you talked about, where, I mean, you guys have done this really well at TribeVest, where you're making it affordable and the economics work, right? For the attorney fees and all that stuff. I think that's really the key.
Yeah, for sure. You have to put it together in an easy package for people to be able to raise capital into. And especially for folks, a lot of folks are raising, $500,000 or $1 million on the smaller side. and it's not their full-time profession. Maybe they're a dentist or a doctor or a
Right.
lawyer.
Yep.
And they just want to put this together. They're not really running this business full time. Well, they need some help. They need somebody to put this package together and just make it turnkey for them to be able to launch a business like this.
100%. Yep. That's the key for sure.
Yeah, let's switch gears a little bit, man. I always like to ask my guests this question. In an alternate universe where you weren't buying $2 billion worth of multifamily real estate, what else would you be doing? What's a different version of you? And I'll give you an example. For me, I went to med school for 1.5 years and hated it. And I dropped out and I went a totally different route. I could have been a doctor. That would have been a totally different life. Not better, not worse, just different. What's that for you?
Yeah, that's a good question, Seth. Because I feel like I still haven't even figured it out. Like I wanted to be first I wanted to be a football player. I'm like, okay, I'm not going to go to the NFL. Then I wanted to be a sports reporter. So I got a degree there and did that for a little bit. I was like, oh, I don't really like this. So then I was like, I don't really know what my passion is. So let me just make money and get like freedom to pursue my goals. And even now, like I do really enjoy building businesses and teams. Like that's what's fun for me is the challenge, but I'm not like in love with real estate. You know what I mean? It's not like I have some background as like the son of a real estate developer or anything like that. Not in this. I just look at real estate as like a good path to build the financial and social resources to get to a higher level of what I want to do. And so I don't know exactly what it is, but it's some combination where I feel like I'm like, I don't know, I feel like God put me on this earth to have a big impact on a combination of like education, media, business, and politics. And I don't know what that looks like exactly, but those are kind of the things that I'm passionate about, like, mass communication and how is that influencing society. I'm getting really involved with Grand Canyon University, which is like the largest private Christian university in the country. That's where I got my MBA, and I'm trying to really get involved with them because I believe in not only like higher education, but what are students, college students, which are obviously the next generation and they make up the workforce, like what type of ideals are they being influenced on? You know what I mean? And how does that relate spiritually, religiously, politically? So I'm passionate about that. And I just feel like real estate is like a really good channel to kind of build up these resources to then do bigger things. But I think, ultimately, we want to have like a venture capital firm where we have like a mothership and then we have different pillars or lines of business, and we've got like management teams and CEOs running each business, and we're basically running like a big venture capital firm. And so we are kind of like building that out on a small level right now. We're with Rise48. We have our investment firm, we have our property management company, we have our construction company, we have an HVAC company. We actually just started a tax company because we have really talented CPAs on our team that are doing now all the tax returns for our fund managers and capital partners, and we can actually do it cheaper than third parties and more efficiently, and it's also a profitable business line. So we're basically kind of building that out now, but we just like building businesses and being parts of teams, and so we really want to scale that and kind of blow it up going forward.
Yeah, I love that, man. Well, you're definitely a master of scale. I can see that even from a distance, the way that you're able to put systems and processes in place. Doesn't matter what vertical of the business it is, whether it's acquisitions for the multifamily business, or you're doing construction, or it's an HVAC company, CPA company, like all these different things. Just putting those building blocks together and preparing it for scale seems to be your zone of genius, man. So congratulations. And thanks so much for coming on the show. I really appreciate it. Where can our listeners find out more about you?
Yeah, thanks so much for having me, Seth. I really appreciate it. And yeah, you guys can go to our website, rise48equity.com. So RISE48equity.com, and you can set up a call with our team. You can shoot me an email, Zach, ZACH, at rise48equity.com, and look forward to connecting with anybody.
All right, Zach. Appreciate you, brother.
Thanks, Seth. Appreciate it, man.
Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.